Thank you, Ben. And as Ben mentioned, I'm Dan Smith, head of data here at Blockworks Research, and excited to lead a fantastic discussion today around crypto data. So we really get to talk about the evolution of that. And if you rewind back to maybe 2017, even before that, crypto data, blockchains are awesome, right? They're these giant open APIs, effectively, that anybody can access data through. But the realities of actually pulling that data off-chain and getting a deep understanding that and augmenting it with off-chain data, like centralized exchange data, or even real-world market data, is an extreme challenge. And you fast forward to today. We have a lot of great businesses that are making that much, much easier and allowing new businesses to be built on-chain. So we have a great panelist crew today through all over the data stack, if you will, all the way down to the infrastructure layer and all the way up to companies that are building products on-chain today. So maybe if we can do a quick round of intros. Larry, I'll start with you, if we can work our way down the list here.
Sure. Larry Wade. I work for PayPal. I head up global risk and compliance for the blockchain, crypto, and digital currency group, which also includes our cross-border payments business. So stablecoins, cross-border payments, you'll see that a little bit. I also head up compliance for our corporate staff areas, so finance, legal, real estate, HR, and risk platform.
Shawn Douglas, co-founder and CEO of Amber Data. We are the leader in institutional data and analytics for digital assets. Give you some kind of idea of scale, we process about $580 billion a day in notional trading activity across spot, derivatives, options, on-chains, DEXs, DeFi, lending, stablecoins, and deliver that to institutions and regulators worldwide. We've been doing this since 2017, and we're just super excited because now is the time.
Hey, Brad Feinstein here, head of Web3 for Amazon Web Services.
Charlie Yu, one of the co-founders of RWA.xyz. We're the leading data platform for tokenized assets. So we give regulators, institutions, investors a 360 view of tokenized assets by combining both the data from both off-chain and on-chain.
Awesome. Thank you, gentlemen. And I want to spend some time today chatting about the history, how we got to where we are, and where we're going in the future. But more importantly, how the clientele has shifted in the teams that you're working with. So, Shawn, maybe I'll kick it over to you first. I'd love to get your perspective on maybe how, you guys have been around since 2017, I believe. And so you've probably seen a lot of the industry grow up and mature in some ways. And I'm curious if you've seen that come through in the clients that come to Amber Data asking for different data. And not only is the clientele, but maybe the types of data that they're looking for.
Yeah, I think the industry has massively evolved in the last few years, and I think in the beginning, people really all they cared about was market data and pricing. I think that's evolved to much more sophisticated perspectives. Everything from what are the as you see a convergence between traditional financial services and digital assets, so now you have derivatives on crypto, you have tokenization of Bitcoin via an ETF, and now derivatives trading on that. So as more institutional players come in, they're interested in seeing the world the way that they know it, even though it's a new asset class. So I think that's important. And then digital assets enables radical transparency that's not available in traditional financial markets. So the ability to actually see flows in stable coins and in liquidity forming in different pools and flows between centralized trading venues and decentralized trading venues just really opens up the aperture on what is possible and the trust that's enabled via the data and analytics into this ecosystem. So we're really seeing, like, as institutional adoption comes on board, their needs of how they run their current businesses are evolving to adapt to the new asset class.
I'll take that even further. So what we've seen is there is a traditional business, and that business requires tooling, and it has that tooling. The pieces are in place, infrastructure, and that's where AWS would come in, core services, storage, network, and compute. And we can rely on the best practices that we've seen on how to build security, data resilience, all those pieces that are fundamental to when you're building a real business. And now we have a hypothesis, right? Blockchains are moving towards real businesses. Real businesses require tooling. So if you are looking at how these two converge, we can take the best practices and then get creative. And that's really been the exciting part of how to use these traditional tools, the traditional infrastructure, and then in new and innovative ways, for the new asset class, for the new startups, for the new enterprises that have different requirements. And marrying those two together has made for this robust new set of applications that are delivering the insights and data required by the enterprise to come into the space.
And I'd love to dive a little deeper there on the tooling section specifically. Like, what do you think the industry was maybe missing 12 months, 24 months ago that you guys are able to come into the market and provide? Yeah, Brad.
Yeah. Back to me, it's UX, it's UX, it's UX. It is still really hard, challenging, and expensive to get the insights and data required at the pace necessary, whether that's latency or across multi-regions, right? It is both complex and expensive. So we continue to need easy-to-use products and visualizations that customers already know how. For example, we spend a lot of times with our customers on data, security, resilience, right? KMS, which is key management, or Nitro Enclaves, TEEs, trusted environments for execution. That's a big piece to this, right? We have, it's called the 11 nines of resiliency, right? So we make sure that when your security is day zero at AWS, which means as you're building across this stack and you're leveraging storage, network, compute, data, AML, the fundamental piece, is it safe? Is it secure? Is it available? And we're still there, right? If you are looking at where VC investment is going, of course it's going to be in infrastructure and now applications. I think we got to see the applications, the flows of money, right? And Larry, keep me honest here, but I think it was $27.6 trillion, right, of stablecoin transaction flows, right? More than Visa and MasterCard together. That is incredible. Translation, we need products, analytics, data for this tidal wave of hopeful adoption, or some might say that adoption is here, and to leverage that so customers and enterprises can understand what that means for their business.
And let me add to that real quickly, and I think, and this is a plug for any cloud service provider, and I think Will probably have a lot to say about this as well, is that sure, front end, but at the end of the day, I have 16 petabytes of data, and that doesn't work in a blockchain. Right. Literally, you need to be able to do analytics at scale to be able to ingest, process, do machine learning, do analytics on top of this, and both Charlie and I have businesses around that. Do you want to add to that, or?
Yeah, one more thing I'll add is that blockchains were really meant for writing, adding transactions onto them, right? It's an append-only immutable log. But what they're really, really bad at still is being able to easily pull data out of that. And because that's so difficult, any financial institution is really not going to want to do that work themselves. And really, they're not even going to want to do all the combining and processing. Like Brad said, I mean, this is a massive opportunity for all the data providers that are able to provide a good user experience at the analytics layer in such a way that the financial institutions are able to understand, mostly in Excel at this point, but maybe some of them will get more sophisticated down the line.
And the wild thing is that data is only going to grow. The nature of blockchains, which I would say weren't built for scale originally, right? There's certainly a lot of innovation that can happen on the infrastructure side of how they're built. It's an always-on function. So it's always with the archival node piece of it, how you draw that data, where it comes from, read, write, all the different pieces. The chattiness, the noise will always grow.
Yeah, Shawn, that point resonates. We just finished a Solana backfill. I think uncompressed, it was like a full petabyte. So yeah, you're completely right. And we do need this Web 2 scale. And in many ways, maybe that was one of the huge benefits of spending all that time scaling cloud software, is that we can now leverage that from a blockchain analytics standpoint.
I welcome your data architecture conversations for whoever wants to come find me.
And it's interesting. So we mentioned product. I'll take it from a risk and compliance perspective, and mine is a little bit higher level than the infrastructure, et cetera. So kind of when it comes to data, there are 3 areas I really think about. So one, new product launches. So take our branded stablecoin PYUSD, regulated by NYDFS. There were approximately 130 risk and requirements identified to launch that product, with each one having at least one control across 20 coverage area teams. The need for data. And not only data where I need to ensure that our ring-fence customer service team can answer questions, because this is something new, but then also, is this aligning to our voice to the customer as we're launching this product? Is it going to be ready for me to communicate with my regulatory partners, et cetera? So I'm thinking of data in a different way and utilizing all of that internally. After you launch, now it's the continuous monitoring, because it never stops. Something cool about this technology that, and I get really excited as a risk and compliance nerd, because when I hear people say, there's just nothing but bad with this, and I don't, the ability to get analytics you cannot get in the TradFi world when you introduce blockchain technology, it's just massively different. So I'm not only monitoring for nefarious activities, right? BSA, AML, sanctions, fraud, et cetera. I'm also looking at patterns. Where is PYUSD being utilized and what DeFi protocols and why? Why is this in some Telegram group and it's being used as a, so I'm looking at just good, bad, everything. And then after that, it's the continuous regulatory adherence and engagement as well. And I can tell you, because I get to work with regulators all around the world, one, they're interested, they're leaning in, they're asking for additional data elements, and also asking, one, how are you thinking about it? How are you using it? So not only from an adherence perspective, but also from a strategy perspective. So I'm kind of looking at data slightly different.
Yeah, I think it's a great use case because, you know, in addition to all the traders that we serve, we have a lot of risk departments from exchanges, from regulators. They're very, very interested in stablecoins, variance from peg, velocity, flows, you know, cohort analysis on wallet activity, exposure across all of DeFi pools. You know, like if you go back to Silicon Valley Bank, when Silicon Valley Bank went bankrupt, Circle had $30 billion in Silicon Valley Bank, which caused a debigging on a single exchange. And that has contagion and propagated through the entire network around the world for like 3 days, right? So you, like all the things that you're talking about, they're like stablecoin risk and stablecoin visibility is so mission critical to all of digital assets. I mean, a lot of exchanges, they don't even trade in US dollars. It's against stablecoins.
And it's interesting, just from that kind of real world blockchain, think about the reserves in a stablecoin, especially a regulated stablecoin, you know, cash and T-bills under 90 days, reverse repos, needing attestations, reconciliations from on-chain to the custodian, minting, burning, follow the sun. The amount of data that is required, not only from a technical perspective, but also real world, and then the third parties that I believe you'll see increasingly playing an important role on the validation. Again, attestations from AICPA, you know, governed firms, et cetera. So that real world, I think we'll start to see a lot more of that. And the trust from the institutions, the activities, the best practices that are leveraged, that's what's gonna allow us to kind of make the space grow.
There's a step further as well. I have a background in traditional payments, so we wanted to know everything about the customer. What did they buy? What age were they? What are they likely to buy next? Where are they going to go? How can we serve them ads? How can we serve them opportunities? And I think that that is the evolution as we're going to see, certainly for stablecoins, what comes next. How do you tap into that customer and expand the opportunities? And where in the ecosystem can you plug that in? So to me, the opportunity is so vast given, one, the growth trajectory that we've been seeing, two, once there's real regulation, perhaps a Genius Act or beyond comes in, and we can start to see larger and larger players, the need for what the folks here on this stage provide is only going to serve the industry magnitudes and magnitudes more because of the need from the end customer to understand what's happening.
You guys thought I was blowing smoke when I said we got the full data stack here, all from the top layer business decisions down to the infrastructure. But no, I was telling the truth. So yeah, Larry, I love your framework of the three prongs there, and I'd love to kind of honestly dive down into each of those. And on the compliance from a regulatory perspective, have you seen like a change of tune in how regulators are kind of coming at the industry? You know, you mentioned the nefarious piece there, and like, you know, historically that feels like that's always what they were looking for. But you know, we just had the president give an address earlier, which was kind of doubling down on the need for the Genius Act as well as the market structure bill. And I'm curious if you've seen that in some of the conversations that you've had at PayPal.
Yeah, actually I have. I've seen just an increased kind of desire to partner and learn. And again, not just in the US. I was in the UK in December. And it's this notion of, yes, we are your regulator. We need you to adhere to whatever requirements. But also we want to learn and partner because I like to say that 80% of this is tried and true, we can leverage best practices. And I was a management consultant before doing this on Wall Street banks. You can leverage up and down the 3 lines of defense from a risk perspective. That 20% delta truly is net new, unique, and fun, right? For example, in PayPal, when we enabled transfers, I had an edge case that I posed to the team. Okay, we are listing Ethereum. Technically, an ERC20 that we're not listing could send to that address. We have to cure for that. That is a truly net new risk that you have to build controls for, and that's exciting. And those are the conversations that I'm now seeing my regulatory partners kind of ask about how are we thinking from that perspective. So definitely leaning in. I'm seeing it globally too. And I would say that from the US perspective, personally, I think that the DFS Part 200 is the most robust. So that's kind of been the benchmark that PayPal's used from the beginning. And I was employee 1 for risk and compliance to build this out for the little startup Dan had that turned into a pretty good business now. But from there, I think those that can kind of leverage those best practices from New York, and then other states that are starting to come online, getting ready for California, et cetera, you'll be in a good place for when the federal kind of stablecoin legislation and market infrastructure comes into play.
Awesome. Any follow-ups on just engaging with regulators in a more positive way?
Yeah, I mean, having been in crypto for 8 years now, I kind of wanted to say a couple things that's interesting on the regulatory front. I think the past few years, everybody in crypto has kind of had this experience of Gensler was a complete clown and gave everybody a bad reputation as a regulator. That simply isn't the case, though. We've been working with regulators for 2+ years. They're very sophisticated, very knowledgeable, and in some cases, interested in all the mechanisms and enablement and the transparency that's enabled by digital assets. And now it's like full speed ahead. They're all leaning in, and I think that they're ready. They're not starting from zero. They already are knowledgeable, so they can come in and have a super high fidelity conversation with you, and they're already clients, so they can get all the data that they need to answer the question. So I'm super bullish right now on regulators, which sounds crazy coming from 8 years in crypto.
No, I'm with you. And one thing, I say this in every speech I have, I call it my little zip code method, right? And it goes back to that 80% and the 20. So I think that when you're meeting with your regulatory partners, one, obviously you want to have respect and transparency, et cetera, but try to kind of get to the right zip code, and meaning best practices, don't reinvent the wheel if you don't have to, and then kind of get into that actual address, that 20% there. So I think kind of engaging with your regulatory partners with that partner, hey, they know what they know. If they don't know, it's not necessarily coming from a bad place. Work together, educate. I think that it'll help all of us. So I'm a big proponent of that, rather than it being adversarial.
And even continuing on the idea here of leveraging best practices from a world that already exists, right? Like data standardization. Charlie, you're spending a lot of time working with real-world assets, and I'm curious on your viewpoint here of, TradFi has really done a great job of building out frameworks that work when it comes to risk monitoring and things of that nature. When we start bringing these assets on chain, do you feel like we are continuing that notion of having strong standardization to make analysis easier, or is that an area of opportunity for us as an industry to spend some more time aligning on frameworks, whether that be from an accounting or data schema standardization side?
I actually think it is the biggest opportunity for standardization of finance on public blockchains, where I would actually say that the transfer of, essentially the work of a transfer agent is essentially solved by ERC20 and other fungible token standards on blockchains. The role of a transfer agent when everything is on a blockchain is essentially not needed anymore. But there's a lot of other service providers that send data back and forth. Billions, maybe even trillions of dollars are spent synchronizing data from one service provider to the asset owner to the ultimate holder, all the way up and down the stack of who holds this asset. And there's no reason why that has to stay that way. Blockchains are absolutely incredible. There's been because of what was mentioned before with stablecoins settling trillions of dollars of value, there's no reason why all of the data can be done in the exact same way, where you have strong standards using public blockchains and having the source of truth be on chain, and then data providers such as ourselves will be able to disseminate that to everyone who needs it, instead of everyone having to have bilateral communication, syncing, which probably causes most of the issues with transparency and everything else that's caused numerous financial crises in the past.
Not only is it expensive, it's time consuming. It takes various amounts of time, days, weeks even, to settle these different transactions, and they're also quite costly. We now have a near instantaneous method to transfer, which I think is going to be an incredible opportunity. Plus, it doesn't go off, right? Oh, Friday, time to go off. We see on Monday. That is no longer going to exist, and I think it's such an one, interesting opportunity, and two, will open up so many new financial innovations that we have not had the ability to see yet.
Yeah, I want to follow on that if I can. Just the magnitude of the tokenization that's going to happen in the next 10 years is just mind-blowing. So if you have BlackRock saying they're going to tokenize $70 trillion worth of assets by 2030, that's not that far away. You have Apollo that's launched a $1.8 billion tokenization of I think it's a debt fund or what have you. You have Franklin Templeton with Benji that's tokenizing money markets. And now you've seen this convergence between crypto or digital assets and TradFi, where Coinbase is talking about tokenizing their security. You're going to start to see these securities. It's like securitization is tokenization, is the future of financial services on better, more transparent global rails that not only speaks to the future as a fabric, but also speaks to a whole different generation of people that want to get on board, and that opens up the TAM for everybody who's an issuer to a global TAM rather than just New York asset managers, right? So I think there's just so many critical things that happen as part of RWA, as part of tokenization, that is just going to transform the whole fabric of financial services.
And from a product perspective, okay, you have faster, cheaper, instant settlement, programmable, right? So the benefits are there. Now, throwing the risk and compliance hat, it actually lowers the overall systemic risk in the space, because truly, and we're just early days, the tools that we already have, think about the tools we're going to have, from on-chain analytics, predictive software to help with, hey, you know what, this fraud typology we've never seen before. This has happened this way, and utilizing maybe an AI tool overlaying, we've actually identified something we haven't. So I actually think that, one, it'll increase the velocity of value transfer and activity, but then also simultaneously, I think it can actually lower the risk of these activities, which again brings confidence and then hopefully also increases the velocity.
This is a great panel because of the diversity of the backgrounds.
Hey, I promised you.
Yeah. So when you talk about risk, you think about what happened when the great financial crisis, right? You literally had structured products, people wheeling in, wheelbarrows full of contracts to try to figure out what the hell is going on. Well, if you think about where we're going and putting things in, I'm keying off what you said about it's coded in a smart contract, and you have these composed, financial products that's all on chain. The source of truth is right there in code. You can see what are the relationships, how much has been rehypothecated, what is the leverage, what are the flows, what the hell's going on. You can't do that 10 years ago, right? The future is just going to be amazing.
And I would say that future is not even, that it's already here. It's just not even spoken about, or really many people don't know about it. The example I'll use here is that with Figure, they're a more traditional HELOC lender. You can go to figure.com and get a loan against your home equity. And what many people don't know is that they actually post all of that data from every single payment from the tens, hundreds of thousands of home equity lines of credit that they originate. They post that all on chain in real time as they get it. And so that's just one example of where a provider such as ourselves, or we're working with them, we'll be able to actually create some sort of recession risk indicator by, you see consumers starting to default on their home equity lines of credit, or maybe the economy's really good, you can see prepayment data all flowing through. And that's actually that is the most real-time feed that you can get for that type of financial instrument. It's not available anywhere else. Actually, in traditional mortgages, sometimes it can take up to 45 days to get that data versus in minutes when it's currently being done on a blockchain.
That's exactly where we need to focus time. a new set of tools, and tools can be yield to do amazing things, or they can be yield for destruction. And when we are seeing businesses choose the tooling set that we've created because it solves a problem in the most efficient, better, faster, cheaper way, that is when we as a collective industry has started to hit product market fit. So what gets me really excited, and I do spend a tremendous amount of time with infrastructure, is seeing across the stack. Because when you are able to translate those efficiencies into business growth or business value, then that will encourage more into the space. So exactly their strategy has been blockchain behind the scenes, and we choose to use it as an example forward-facing, is hopefully what unlocks in this next chapter of our adoption. It's exactly the types of applications we want to see.
Yeah, this is a fantastic example here. That's they're building on Provenance blockchain, right, Charlie?
Yep.
Oh yeah, it's incredible to see that. And one of the things that's interesting here is like we get to that world when more and more stuff is on chain, because there's kind of like this mismatch between off-chain data, right? We kind of hinted at that throughout this whole discussion, where it's like, oh, it's a weekend, so we don't really know what's happening in the off-chain markets, but we can constantly see this in the on-chain markets. And so when it comes to tokenization, or even just getting like a better understanding of the industry, like I'm curious if you guys see those problems arise as well, but trying to marry that off-chain data with the on-chain data. So Larry, if that's for you, for maybe like trying to compare risk or compliance perspective for PYUSD versus some of your other products, like is there a mismatch there, or even Charlie, do you see on the tokenization side of things? I'm curious just to know more if like marrying those two together, right, the off-chain and on-chain components, like the time lag is creating any issues, and would we be better served if more and more activity keeps moving on-chain?
Yeah, I would say that it's only going to get better as everything moves on-chain. I mean, particularly from a risk and compliance standpoint, when you can have the full audit trail of every single change that's ever been made to the reference data of that asset, that only adds to the safety of the asset, transparency for all the investors involved, anyone that holds that asset. And currently, as you said, that's done on daily, weekly, monthly cadences just due to that lag where not everything is on chain. But very soon, we're going to see this be completely in real time, and everyone will be able to have full visibility as those changes happen.
And you mentioned, I guess, a mismatch, if there is one right now, and I think it's just where we are in the evolution. It's just, there still isn't certain regulatory clarity or even, discussed from a regular perspective for some of kind of the off-chain and on-chain, like real-world stuff. So I think as we start to, and specifically on like the stablecoin side, right, or like if you're dealing with like FBO funds and things of that nature, you won't see stablecoins mentioned in any permissible asset for FBO funds in any money transmission license, most likely. I'm not a lawyer, but I haven't seen it. But they never had to think about it. So it's not that they did something wrong, it's just it wasn't a thing. So I think as we continue to evolve and more guidance comes, I think that will kind of become a lot cleaner. But just for what we are utilizing, for example, we recently, and this was in the news for our Zoom cross-border payments business, we now, with a few pilot partners, are settling in PYUSD. Now, a cross-border payments business, you have a send country, you have a receive country. We have about 200 receive countries. So I'm sending money home to the Philippines. The way something like that works is, there's pre-funding via wires to disbursement partners in the Philippines. And then depending on how the end user wants to receive his or her funds, whether it's cash pickup, digital wallet, et cetera, it's expensive. It seems like it's in real time, but there's some credit risk, there's pre-funding, et cetera. Imagine now us being able to settle with that disbursement partner in the Philippines with stablecoin. The wire cost goes away. I can't do this on the weekend. The ability for the pre-funding requirements goes down because now it's in real time. That is a real, and then now because the cost and time goes down, we can pass that along to our customers. That's real world, which on-chain, happening right now, and that's happening in a fairly seamless way.
Okay, so what do we need to do to accelerate towards that world, right? Because if I'm thinking about this exact example, right, I want to send money home to the Philippines. So I think the infrastructure piece, like you guys can do a great job obfuscating that away from the user. But then on the reception end, does the user who's receiving the funds in the Philippines, do they need to have an economy that's built around accepting stablecoins as payment? Like,
It's a good
that the piece that
question.
needs to come in?
So the way it's currently constructed, they're receiving the fiat payout of their choice. They have no idea this is happening.
It's beautiful.
Because there are a lot of opportunities to kind of revamp the pipes. So PayPal, we have about, 420 million wallets, in a two-sided network in 200 countries. We have both sides. So we get to actually play around with the pipes a little bit. So in this case, the end user, there is nothing different. They have no idea this is occurring. This is just us improving the efficiency and then ultimately being able to pass down cost savings.
Yeah, I want to go back to the risk thing for a second. I think it's, the world is operating a 24-hour, there's information around the world, around the clock, happening in real time on X, on whatever your social media platform, on news channels, etc. Traditional, archaic markets close at 4:15 on a Friday and don't open till, if you're trading futures, 6 o'clock on Sunday, right? The world doesn't operate that way anymore, and most big events seem to happen on the weekend, right? Like paying a trader, this is like when bad things happen. Well, there's this gap between, hey, I'm in an active liquid market in CME or on NASDAQ, and I can look at price levels and where liquidations are going to happen, and I can look at dealer net gamma to understand price impact and the potential for a short squeeze, etc. But when those traditional markets are closed, you're screwed. And if you're holding crypto derivatives over the weekend on CME and there's a 10% move in Bitcoin over the weekend, which just happened not too long ago, it's bad. But now with digital assets, it's actually amazing because you can start to understand and quantify that risk around the world, around the clock, from a liquidity available to open interest, to dealer net gamma positions to understand price impact, to looking at a lending protocol like Aave, which is effectively a repo market, which facilitates leverage for things like arbitrage between centralized exchanges and decentralized exchanges. You can start to understand what's flows, how is funding is happening, who needs to be liquidated, which is effectively cleaning up a risk in the system. And the whole world is converging on this. It needs to be real time. It needs to be now. And the traditional markets, they're just not there yet. And so I think that digital assets brings this transparency. Even though today you're stuck, spanning these two worlds, I think that the transparency available in these markets is going to change the game, right? And yeah.
And I didn't answer your question on the last mile about, do they actually need to have an unhosted wallet or a yellow card exchange in Africa? That's where we are in the evolution of this. To your point, right now, we are utilizing stablecoin in that flow to improve the pipes. Ultimately, if you're in a certain country that maybe your currency is being devalued and you want to receive a US denominated stablecoin, you're going to need to have a wallet to be able to do that. We're going to need to be able to have on-chain analytics tools for monitoring, et cetera, to make sure that nefarious activity is being monitored, SARs are filed, et cetera. But I think that'll all start coming as the network effects kind of come into play.
Yeah, that's awesome. And I think I saw a tweet the other day. It was something to the effect of like, oh, if you think stable coins are complicated or adding unnecessary complexity, like just try to send a bank wire. I recently bought a house and that was like a good reminder of like, okay, I'm in the right industry. We're moving in the right direction because it is painful. It truly, truly is. And I think the other piece that you said that was really interesting, Larry, was the idea that the user doesn't have to know that's happening, but how much simpler that gets between the send and receive country, right? When there are different regulatory differences, I can imagine that that's a bit of a challenge. I'm curious if my categorization there is accurate and if that reduces the amount of friction required between the transaction to happen.
Yeah, 100%. I mean, to pre-fund with the wire, to your point, you need to initiate a wire. You have to deal with the, there is a likelihood that wires fail. You don't know, things happen with wires, right? Then you're pre-funding, so you have dormant capital. There's additional operational complexity because there's more human reconciliations involved, et cetera. So when you can now have a stable coin utilizing smart contracts with that instant settlement, to your point, monitoring, knowing when to top up, when not to, it's absolutely more efficient. And again, we're just getting started. And I think as we kind of open up, on the regulatory side, and that clarity comes, and now you can play a little bit more, I think we'll probably see things accelerate at a faster pace.
Many of buying a house was built that way because it was there for protections, right? We now see what it is like to buy that house today. But when we think back how it was structured was because at that time, it needed to be that way. So to answer a question you had a while ago, which was what do we need? It's more users, right? It is more people recognizing that this is a technology that they want to participate in, and then finding, let's say Web3 native applications, and then working with Web3 integrated enterprises. And if you pair those two up, that's when we start to see adoption. We follow the ways that exist because there have not been alternatives. And we're now approaching a time when we will have alternatives, and many of the answers that we have been looking to solve, do people really want it? Is it better? Is it faster? Is it cheaper? Will be determined by how much, how fast, how quickly users truly adopt this technology, and the businesses that begin to integrate these pieces into their day-to-day structuring. That gets me really excited, hearing about what PayPal is doing, seeing that, visualizing it, being able to not just tell my parents what I do abstractly, but saying, here, the parents test, I'm gonna go do this for you. So it brings me a big smile to have that happen.
Yeah, I feel like that actually ties this full circle, right? I think the first thing we were talking about was regulation, and clear regulation allows the companies that are closest to the users to onboard this technology, which again just is probably the biggest catalyst we've all been begging for what feels like the last five years or so, and now it's coming to fruition. So, gentlemen, this is a fantastic discussion today. I really appreciate you all taking the time to have a great discussion on crypto data, and I think I don't know, I gotta say, I think that was one of the most interesting panels of the day. I think I'm biased, but we did it. Thank you, gentlemen.